When people talk about mortgages, they're usually referring to 30-year fixed-rate conventional loans. But that's not all that's out there. Mortgages aren't one size fits all, and there are a whole bunch of different loan types. Today, we're going to focus in on two of them. We'll talk about the differences between conforming loans and jumbo loans. Most home shoppers are going to be choosing between a conforming loan and a government-backed loan. But if you're looking at higher priced properties, you might be choosing between a conforming loan and a jumbo loan. And something else that's going to come into play that you might not expect is your location, which can also determine whether you need a jumbo loan or a conforming loan will work. Sound like a lot to get into? It kind of is, but take a deep breath, get ready, because we're diving in now. Conforming loans are mortgages that fall beneath a price threshold called the conforming loan limit. Conforming loan limits vary depending on where the property is located. It's based on counties. So most counties in the United States actually all have the same conforming loan limit, but if you're in a really expensive area like New York City, San Francisco, Honolulu, conforming loan limits are going to be significantly higher. Every year, conforming loan limits are set by a government agency called the Federal Housing Finance Agency. The FHFA regulates Freddie Mac and Fannie Mae, and they set conforming loan limits. They change them each year based on what home prices have been doing. So if home prices have been going up significantly, conforming loan limits are usually going to see a decent bump as well. If home prices have been kind of sluggish, the conforming loan limits might change only a little or not at all. Why does FHFA care how large your mortgage is? Well, that's because mortgage lenders don't usually keep the loans that they make on their books. Instead, they'll make a loan and then they sell it on the secondary market, and then that sale gives them money to make more loans and keep giving people mortgages. The biggest buyers of loans in the United States are Freddie Mac and Fannie Mae. To keep Fannie and Freddie safe, the FHFA sets up rules for the kinds of loans that they can buy. That's why conventional loans have to conform to these different standards. That also means that conventional loans tend to have stricter lending guidelines than, say, government-backed loans. It's because these loans are meeting the standards not only set by lenders, but also set by these government organizations. When might you need a non-conforming loan? Well, government-backed loans like VA loans and FHA loans are simple examples of non-conforming loans. These are judged by their own separate standards and rules, so even if you're buying a property with one of these loans that fits below conforming loan limits, it doesn't matter. They're being judged completely separately. If a borrower doesn't meet certain qualifications for a conforming loan, like maybe around credit score or something with their income, a lender can choose to offer them a non-conforming loan as a way to still allow them to become a homeowner. In this case, it would be something called a portfolio loan because the lender would keep it on their own portfolio since it can't be resold. That said, a more common type of non-conforming loan is the jumbo loan. As their name implies, jumbo loans are big loans. They exceed the conforming loan limits for their area. Because of that, jumbo loans are non-conforming loans. They cannot be resold by lenders to Fannie and Freddie. That means that if a lender chooses to make a jumbo loan, they are keeping it on their books. This gives lenders a bit more risk because if a borrower is unable to repay the loan, that's coming out of their pocket. Because jumbo loans are for larger dollar amounts and because lenders are assuming a bit more risk than them, they have different qualifications than conforming loans. At the same time though, because lenders don't have to answer to Fannie and Freddie and don't have to follow those conforming rules, they can have a bit more leeway when they're deciding what they're going to require for jumbo loan borrowers. Since lenders can set their own requirements for jumbo loans, requirements are going to vary. But here is a general idea of what you could expect if you're looking for a jumbo loan. In general, your credit score is going to need to be on the high side. Usually 700 is about the floor if you're looking for a jumbo loan. Lenders are also going to want to see that you have a good amount of cash reserves on hand or that you've got assets that could easily be made liquid. That's because they're assuming risk with that jumbo loan since they have to keep it on their books. And so they want to know that if something were to happen, you're going to be able to make payments on that mortgage for usually at least 1 year. One good thing, if you do have a lot of cash on hand, is that you can potentially be allowed to have a higher debt to income ratio. That can sometimes be as much as 45%. If you don't have as much in the way of cash reserves, your debt to income ratio is usually going to need to be lower than that. Also, down payments tend to be larger with jumbo loans. This is one time where a lender could potentially ask you for a 20% down payment. Something in the 10 to 20% range is normal. Interest rates for jumbo loans can be really all over the place. In some cases, some lenders, particularly traditional banks, might offer a very high net worth borrower a low interest rate on a jumbo loan because they're looking to create a relationship with them and get them to do other banking with them. In other cases, lenders will look at a jumbo loan and say, this is a big loan, we're taking on a lot of risk, we're gonna have to offer you a higher interest rate. No matter what kind of mortgage or what amount you're borrowing, you always wanna get rate quotes from multiple lenders. With a jumbo loan, you are definitely going to wanna shop around. Jumbo loans do not have an upper limit. If you're above the conforming loan limit for your area, you are probably getting a jumbo loan. If you're below the conforming loan limit, you've got options. You could get a conforming or a conventional loan, or you could go with a government-backed loan. Where you might be in a position to actually choose between a jumbo loan and a conforming loan is if you're looking in a high-cost area and where your home shopping budget has you, you are right near that conforming loan limit threshold. Depending on what property you're looking at, maybe even what kind of offer you make, you might need a jumbo loan, or you might be able to swing a conforming loan. If that's you, you could do a couple of different things. One, you could accept that you're going to need a jumbo loan, work on getting your finances in shape for that, and start looking for jumbo loan lenders. You could say, no, you know what? I'm going to stay below the conforming loan limit no matter what happens, but know that that means that you have got a hard line. If you end up in a bidding war or a counteroffer situation, you might have to walk away if you hit that price threshold. Or you could split the difference and do a piggyback loan. A piggyback loan, also often called an 80-10-10 loan, involves getting two separate mortgages. This allows you to buy a property that's above conforming loan limits without having to take out a jumbo loan. Here's how it works. So for your primary mortgage, you're going to get a loan that's for 80% of the home's price. That is what is going to put you below conforming loan limits. Then for that remaining 20%, it's going to be split into two little pigs. The first one is going to be a 10% mortgage. So it's a mortgage for 10% of the home's cost. In a lot of cases, lenders that do these kinds of loans are used to working with this kind of thing. So the lender that gave you that 80% loan will actually recommend you to a second lender to get that 10% loan. The other little pig is going to come from you. Unfortunately, that is going to be your down payment. Since you are doing a fairly elaborate loan that's also high cost, it's not too surprising that they do want you to make a significant investment. By working your loan in this way, you are borrowing a lot of money since you're borrowing 90% of the home's price. It's also important to remember that you are applying for two separate mortgages, often at the same time, because that smaller 10% loan is still a mortgage. That can be a lot to deal with. The choice between a conforming loan and a jumbo loan is usually made for you by your location and your budget. But if you're in limbo, you could opt to go one way or the other, deciding you're just going to shoot for that jumbo loan or that you're going to stick below conforming loan limits. Or you can get a little bit creative with a piggyback loan. These can be tricky, but it could be well worth it if it helps you get the home that you really want. I'm Kate Wood, and I write about mortgages and home buying for NerdWallet. If you want to learn more about conforming or jumbo loans, head to our site for more resources. But while you're here, like and subscribe for more.